Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with Brien Lundin. We had an amazing interview a few weeks ago. It went crazy viral. I brought him back onto the show. He's with Jefferson Companies. He writes the Gold Report. He hosts a big conference in New Orleans every year. I think for 40 years. So if you want to go to it, it's the one show to go to every year. Brien, thank you so much for joining us.
Great to be with you again, Dan.
Well, hey, Brien, you just got back from the largest mining conference annually, the PDAC show in Toronto. And just start us off with, what was the crowd like? What was the feel like in the room after this severe bear market that these companies have been going through?
Well, it was a good crowd, and I think that was indicative that it's business as usual to some extent. I didn't get a lot of a sense of a lot of excitement that say we're in the midst of a turnaround or that a turnaround is near. But most people at the show seem to share my belief that we're bouncing around the bottom, that we've not necessarily seen the absolute lowest prices for the metals, but that they can't go much lower than this because we're right around the all-in cost of production. So that your downside risk is maybe 20%, but the upside risk for really good companies that have good projects is on the order of 300 to 400% once the market gets back in gear.
Now, how do the currencies play in for these miners? Because most of these guys are sitting in Canada, right? They got their offices and their headquarters in Canada, but they got projects everywhere: Brazil, Russia, the United States. Now, obviously, if you have a project in the United States, I assume that it's not a good thing because the Canadian dollar is depreciating against the U.S. dollar. But everywhere else in the world, let's say you have a project in Russia or Brazil, is there any benefit to the collapsing currencies around the world in the environment of mining and exploration?
Well, there's really a tremendous benefit, and that's a very good question. It's a good point that relatively few people are picking up on, but more and more so every day. The fact is that projects in any country outside of the United States, their costs are based in the local currency. Yet every gold project, for an example, in the world, their end product is priced in dollars. So as the local currency falls against the dollar, your costs fall, and yet your selling price, the price of your product, stays the same. So it's helping alleviate the impact of the low metal prices right now, and it's actually improving the economics of many mining projects.
In the last few years, we've seen a few of the mining shows shut down, like the Hard Asset, the show in San Francisco. Cambridge has reduced their shows to just Canada, and they're doing tech conferences. What was the PDAC crowd like? Was it less than normal? Was it more than normal? I mean, compared to like 3 or 4 years ago?
I haven't gotten any of the official numbers. They bounce all over the place, and you hear cab drivers mention some astronomical numbers that they may have heard. So I don't have any feedback on that. It seemed like it was a large crowd. It's obviously much larger than it was back when I was going to that show in the early 90s. Mm-hmm. But as opposed to recent years, I would say it's probably down a bit from, say, 2011, 2012. Not an awful lot. It was still a very large crowd. It's still like a zoo in the frozen tundra. It really is hard to get around. It takes a lot of time an effort to try and find people and get to various meetings. So it is hustling and bustling, and you only really get a sense of the market temperament or sentiment when you're talking to people individually. If you just looked around, you would have thought it was a rip-roaring bull market because there's just so many people going around. It's probably more that more people are going around looking for money, and there just aren't as many people handing it out.
That's interesting. Last time we spoke, we discussed Alan Greenspan and some private conversations you had with him, as well as conversations he had in the public forum at your recent New Orleans show conference. I wanted to ask you, with world currencies down big against the U.S. dollar, what does this mean for the U.S. In in the context of it has low interest rates, it has QE, so everybody was kind of expecting inflation. However, does this hurt or does this help the Fed's goals? Because essentially the Fed is getting its ass handed to them in the currency war right now, right?
Yeah, to whatever extent that it matters for the Fed, because they don't need to be profitable, or they literally cannot go bankrupt. But Greenspan made some good points to me. I asked him about that. When we talked, we were just around the advent of quantitative easing for Europe, and Greenspan noted to me that on the effect of that on the U.S. economy would probably, in other words, a weakening euro would probably not be that damaging, because it only represented, say, 15% of our overall global trade, Europe in general. So he kind of dismissed that effect. But he was concerned about inflation, and he was specifically concerned in relation to the outstanding or the excess reserves, which are close to $3 trillion being held on the Fed balance now, which represents banking reserves of the banking system, where it's paying out about a quarter point of interest to banks where they're holding their reserves at the Fed. That money is just over the economy, the U.S. economy, like a big old water balloon of liquidity, and it's just searching for a pin. In fact, Greenspan referred to it as a tinderbox of potentially explosive inflation, just looking for a light or a spark. And he recognized that was primarily the issue that would result in much higher inflation for the U.S. down the road. That he seemed to believe it was somewhat inevitable that the release of those reserves would create much higher inflation.
Well, like you told us last time, he said gold would be measurably higher. So now with the Fed, they're so dovish. I mean, Yellen came out I think yesterday, just these extremely dovish policies. They're encouraging the market to keep the rally going. And I want to know if either with your talks with Greenspan or just with your research, what is the Fed's ultimate goal here? I mean, what do they think they're going to achieve? When do they think they can ever exit from this, from quantitative easing and from these easing policies?
I think the Fed just hopes they can get out of this alive. Metaphorically, I believe they have to recognize the impact of higher rates on the budget of the United States and the fiscal situation. That a normalized interest rate environment, which is what they say they seek over the longer term, is fiscally impossible for the U.S. at this point in time. They, every 1% rise in the interest rate burden of the national debt, I believe that equates to around 100 to 140 billion dollars in added interest rate payment burden for in the annual deficit. So, if you had, say, a normalized interest rates around 5%, we would be paying close to $700 billion every year in interest rate payments to maintain federal debt. Before we paid for any entitlement system payments, before we paid for national defense or anything else. And the American public just isn't going to put up with that. So I think they recognize that down the road. That's why you see them occasionally talk about the fact that monetary policy can only do so much and that there has to be fiscal reform. But I think they recognize as well that fiscal reform is virtually impossible.
Now, in the countries like Brazil and Russia, where the currencies are in free fall, or in Asia, where they're really more friendly towards gold and gold ownership, are we seeing any kind of situation where people are lining up for gold? I mean, obviously, gold's at an all-time high in rubles. So, I mean, are we seeing more demand for gold? Or if you could just kind of cover the demand for gold right now worldwide.
Well, it varies from region to region. In Russia, we've seen the Russian Central Bank make record purchases for the Russian central bank as far as gold and adding to their gold reserves. A lot of people make a big deal out of this, but in essence, the local gold miners who are typically export their gold out of Russia are really unable to do that due to the sanctions regime. So they're forced to sell it to the Russian central bank. And the Russian central bank is glad to do that because they can print up more rubles and get gold in return. So it's a free trade for them, essentially. And that's largely behind the increase in the Russian central bank gold reserves and the additions to those recently. Now, in Asia, there's a different story in that not just central bank demand, but putatively private demand for gold has been soaring, particularly in China. You see from the deliveries, the withdrawals from the Shanghai Gold Exchange, that demand was at a record level in 2013, a level that was a multiple of any previous level. 2014 was only about 4% back of that level, short of that record level of demand. And so far this year, we're running considerably ahead of even the level of demand in 2013. This is largely gone unreported in the mainstream financial media because the World Gold Council doesn't recognize that the Shanghai Gold Exchange is a proxy for domestic gold demand in China. So very few people realize how strong demand is in China, and I think that's literally the biggest story for gold right now.
How about the supply side? And then specifically coming out of that PDAC conferences, what's the future supply look like for gold? Or are we going to have some type of shortage because of what's been going on with the mining sector for the last 3 years?
We will. There's not enough projects in the pipeline. Interestingly, there have been some charts that have been produced to show that peak discoveries for gold projects occurred in 1995, in that it takes about 20 years for a project to go from discovery through producing mine. That's somewhat indicative of the theory that we've reached peak gold production right about now. And actually, the statistics show that gold production is slowing, and we probably have reached peak gold production either this year or the next. So just as we see the large, broad-scale monetary factors around the world building toward a much stronger gold demand over the longer term, we're actually going to start seeing gold production falling. So this is just another one of those fundamental dynamics behind the gold price that seem to virtually assure much higher prices over the longer term.
Yeah, it seems like the perfect storm.
Yeah.
And then, of all things, you look at this TSX Venture chart, and man, I mean, you just draw a line going back the last 20 years, and this is exactly where the bottom usually is. Yep. So looking to try to profit from this scenario and at the same time put your money in good hands, what are some of the spots or areas or investment opportunities that you're looking at with your subscribers to profit from gold and the junior resource sector in general?
Well, I like to tell people, getting back to what I said earlier, that your downside in gold is likely considerably less than 20%. And yet your upside for companies that have proven deposits is equivalent to the upside you would have had from a kind of a wildcat drill hole play a few years ago. I mean, you could literally make 3, 4, 5 times your money by just investing in companies that have significant identified resources. And that's just comparing to what they're selling for now with these resources and what they would have been selling for, or in fact did sell for just a few years ago when the market was much more in a frenzy, if it were. So there are plays like, say, Kaminak Gold, like Almaden Minerals, like Midas Gold, that have significant gold deposits that are selling for a fraction of what they were selling for before. And then there are companies that are actually taking advantage of this distressed marketplace to kind of roll up companies in gold deposits from distressed companies in building reserves at these low levels and really using the cycle to their advantage.
So you're talking about like acquisition rather than exploration?
Yeah. Well, in advancing the projects as well, probably the preeminent example of that would be Brazil Resources. I have mentioned before that Amir Adnani is the CEO of UEC, the uranium producer, small-scale uranium producer. But he's also the CEO of Brazil Resources, which is a company that is focused on Brazil more specifically, but generally has a business model of going out and acquiring world-class gold resources at this bottom of the cycle. They announced this strategy, and I really liked Amir. I was there really at the launch of UEC and supporting him in his efforts in making a success of that company. When he started Brazil Resources, I liked the idea in general, and I didn't share this with him, but there were two gold projects in Brazil that I thought were really outstanding, and he went out and acquired those two projects right off the bat, which was gratifying to me that we both thought the same way. But in the process, he gained about close to 4 million ounces of high quality gold reserves across all resource categories in virtually one fell swoop. And the key here is that I don't think he and Brazil Resources is finished by any means. So in this atmosphere, in this environment of really the very bottom of the resource cycle, a company that can pick up these resources for a song, it's really the time to buy these kinds of companies, these kinds of opportunities.
Yeah, I see that, Brazil Resources, who I'm a big fan of as well, they recently had an oversubscribed private placement. I mean, how often in this market right now are you seeing companies raise millions of dollars? Because if you look at this year's private placement and last year's, which was December 2013 and December 2014, I mean, essentially in 12 months, Brazil Resources raised about $11 million.
Yeah, they did, and they've got some of the smartest guys in the industry backing them and writing checks for them. Interestingly enough, right now, a shareholder or an individual investor can come in and buy that company for a significant discount from where some of these really smart guys bought into the company. So, you're getting in cheaper, and yet you're getting millions of ounces of gold that weren't around when these smart guys invested in the company. And with that said, these guys are continuing to write checks because they like the business model. They understand the potential of that business model at this low point in the cycle, and they really like the management team, which is, as I said, just absolutely stellar.
Brien, it seems like the perfect solution to our perfect storm for gold right now, and I'm sure investors will be very happy to listen to this interview. But what about other solutions as far as like political solutions? Do you see anybody in the political environment in the U.S. that is offering up any solutions to try to right the course? Because, I mean, obviously people living in the United States, we want to be prudent and we want to protect ourselves. And if there is an opportunity, we want to make a profit. But, of course, we all have children. We all have family. We all live here. We don't want to see the U.S. go down in flames. Is there anybody out there that's trying to fix the situation?
Well, I think there are a lot of people who are trying. There are a few of the potential presidential candidates that I like as being much better than anybody else. But frankly, I think it's a political impossibility at this point to avoid any sort of the type of market event that Greenspan was warning about over the short term, and over the longer term, a substantial depreciation of the value of the dollar against gold. The key point, and I always stress this, I've been stressing this for years now, is that federal debt has grown so large, and really the debt of Western economies, including Japan, has grown so large that it's impossible to address the obligations, these mountains of debt, without some significant currency depreciation. In other words, you can't grow your way out of it economically. You cannot raise taxes enough to pay off the debt, and you can't slash spending. We know that's a political impossibility. It can't slash spending enough to pay off the debt. And this interest rate burden is going to continue to rise and rise. So the only way to get out of this is the age-old, the millennium-old solution of depreciating the currency against gold and printing more dollars, printing more euros, printing more yen, so that the value of that debt is diluted by the growing amount of currency in circulation.
You know, it appears with everything that's going on in Greece, it doesn't look like the euro, its future is certain. But if something happens to the euro, does this just make the dollar that much more stronger and kick the can for the Fed and the federal government? Who knows, 10, 20 years from now?
Well, again, there's a shorter term and a longer term answer to that. Short term, there has to be some type of a shift in or change in the almost parabolic rise in the dollar versus its trade currencies. There's just too many people on the bullish side of that trade. At some point, it's going to turn, and it's going to turn dramatically, and that will benefit gold. But over the longer term, it there's no way that the dollar can stand alone as the only strong currency in the world. It's just going to be too damaging to an already fragile economy. So that's going to be the key, the real key factor, I believe, over the next couple of years, is how is that addressed? And if we start raising rates significantly, if the Fed is ever able to do that, then it's only going to bring that day of reckoning closer and closer.
You know, my big concern is, though, when I see all this stuff going on around the world, is that it creates so much instability. My concern is for the sake of the future, for the U.S. economy, or is technology going to be able to carry us through? I mean, ultimately, how do we go through the next 10 years as this debt is probably going to implode? I mean, it's just going to take a small country like Greece or something to set the whole system off. I mean, what is, I'm just trying to figure out, because I haven't thought of this as nearly as long as you have. What should we be preparing for? What should we be doing to protect and prepare our families?
Well, I think what we've seen is that, and this is something that Jim Blanchard stressed to me over and over when I was just a cub copywriter working for him decades ago. But it's an age-old truth that faced with the prospects of deflation, central bankers will inflate to whatever degree is necessary. And we're seeing that in action right now. Central bankers are definitely afraid of deflation. That's the one constant, the one rule, the one thing that all central bankers have in common is they cannot have deflation take hold. And they will print money, they will print currency to whatever degree is necessary, no matter how seemingly ineffective that may be. I think that the turning point for us in the world will come when the Federal Reserve is forced to return to some sort of quantitative easing. And that is something you cannot predict, but it is literally a month-by-month situation as we watch the monthly employment reports, because that's where the rubber meets the road for this Fed.
And then, is it the Fed that would what would cause a crisis? As far as, like, would it be a market-driven? Would the market just reject the U.S. dollar? Is it U.S. dollars coming home? I mean, what actually would ignite this thing?
Well, as Greenspan told me, they cannot. He sees no way that they can escape this era of quantitative easing and a zero interest rate policy without some sort of a market event. And the corollary to that is, in that case, perhaps the Fed will never be able to return to a more normalized interest rate environment, will never be able to exit from quantitative easing, or at least not without a major fiscal reform years down the road. So what that tells us is there's a good chance that the Fed will have to join its central bank brethren and start easing again, just like the European Central Bank, just like the Bank of Japan, just like a number of other banks in the Eurozone that aren't actually in the EU. So if that happens, that to me is the more likely scenario, the more likely outcome of what we're seeing right now. And all I can advise people to do is to keep watching those monthly jobs reports, non-farm payroll reports, to look for some sort of a significant downturn or an increase in unemployment, and that will stay the Fed's hand, and that alone will boost gold to significantly higher prices. But if the Fed makes any noise or appears to be preparing the market for a return to quantitative easing, then all bets are off for gold. It would be the start of another major run higher.
Interesting. Brien, thank you so much for joining us. We appreciate your time. If someone would like to contact you or subscribe to your newsletter, where's the best place for them to go?
www.goldnewsletter.com. That would be the best site to learn about Gold Newsletter. The best place for the New Orleans Conference is simply neworleansconference.com. neworleansconference.com, and we're going to have another great agenda this year.
Yeah, it's a perfect newsletter for the times we're in, the Gold Newsletter. And then, of course, the conference is great. Do you guys have any confirmed speakers yet, or are you guys still in the early stages?
A lot of the usual favorites. I'm still kind of shopping around and trying to make up my mind on who amongst the larger name speakers were in real celebrities figures in in geopolitics and investments and economics. So we really get the best people out there, as you know, and I'm still working on the schedule right now, but we'll have some news very shortly.
Maybe you could get Ben Bernanke to come over and ask him about the old banking tradition of buying gold and storing it.
I'd be tempted, but unlike Greenspan, Bernanke has no concept of gold's role, and I'm not really excited about writing the big honorarium check for Bernanke.
Yeah, I imagine because he's a recent Fed chairman. I mean, I know some of these guys charge, $200,000-$300,000, or at least the Clintons do and Bush's. But I think last I heard, Bernanke is getting paid. It's a really high fee. I thought it was like six figures.
More than I'm going to pay him, that's for sure.
All right, sir. You have a great day, and again, we thank you so much for your time.
Great, Dan. Good to be with you.